Something happened in the early months of 2023 that most people completely missed. Not because it was hidden, not because it was secret, but because the financial world had spent decades convincing itself that certain things were simply impossible, that there were rules to the global economy that could never be broken, that the dollar was untouchable, that Saudi Arabia would never ever walk away from the arrangement that had held the world's financial system together for half a century. And then, quietly, almost without fanfare, they did. This is the story of the day the petrodollar started dying. And once you understand what actually happened, why it happened, and what it means for every single person on this planet, you will never look at money the same way again. Let's go back to 1974. The world had just survived the oil embargo of 1973, a crisis that sent shockwaves through the global economy, caused fuel lines stretching for miles across America, and forced governments across the Western world to confront something deeply uncomfortable. They were utterly dependent on oil, and they had almost no control over its price. In the chaos, the Nixon administration sent Secretary of State Henry Kissinger to Riyadh with a deal, and this deal was so audacious, so perfectly engineered, that it would reshape the entire global financial order for decades to come. The deal was simple, but profound. The United States would guarantee Saudi Arabia's security, American military protection, weapons, political backing, whatever the kingdom needed to survive in a volatile region. In return, Saudi Arabia would do two things. First, they would price all of their oil exclusively in US dollars. Every barrel, every contract, every transaction. Dollars. No pounds, no francs, no marks, no yen, dollars. Second, they would take those dollars and recycle them back into US Treasury bonds, funding America's government spending and keeping Wall Street fat and happy. This arrangement became known as the Petrodollar system. And because Saudi Arabia was the heart of OPEC, the most powerful oil cartel in history, the rest of the oil-producing world followed suit. Almost overnight, the dollar was not just America's currency. It was the world's currency. Every country that needed oil, which meant every country on Earth, needed dollars to buy it, which meant every country needed to maintain dollar reserves, which meant America could print dollars, export them to the world, and in return, receive real goods and services. It was, by almost any measure, the greatest financial privilege any nation had ever enjoyed. The economist Barry Eichengreen called it America's exorbitant privilege, and for 50 years it held. But nothing lasts forever. By 2022, the cracks were showing, and they were impossible to ignore. When Russia invaded Ukraine in February of that year, the United States and its allies did something that had never been done to a country of Russia's economic size before. They froze Russia's foreign currency reserves. Nearly $300 billion worth of assets held in Western financial institutions were simply locked, inaccessible, gone for all practical purposes. And for every finance minister, every central banker, every sovereign wealth fund manager outside of the Western alliance watching this happen, one thought ran through their minds with electric clarity. If they can do this to Russia, they can do this to us. Suddenly, the petrodollar system did not look like a privilege extended to everyone. It looked like a trap. Holding your national wealth in dollars meant holding it at the pleasure of Washington. Pricing your oil in dollars meant being tethered to American foreign policy. And for Saudi Arabia, a country that had watched its relationship with Washington grow increasingly strained under successive U.S. administrations, that had been frustrated by American pressure over human rights, that had watched the United States become energy independent through shale oil and therefore less strategically dependent on the Middle East, the calculus was shifting. And then there was China. By 2022, China was the world's largest importer of crude oil. Not by a little, by a massive margin. China consumed roughly 14 million barrels of oil per day, and Saudi Arabia was one of its largest suppliers. The trade relationship between Riyadh and Beijing was colossal, and it was entirely conducted in US dollars. Every single barrel of Saudi oil that landed in a Chinese port was priced, contracted, and settled in the currency of a country that was simultaneously engaged in a deep strategic and economic confrontation with China. To Beijing, this was an absurdity. To Riyadh, it was an opportunity. China had been quietly building toward this moment for years. The digital Yuan, officially known as the ECNY, or Digital Currency Electronic Payment, the DCEP, was not an accident. It was the product of years of meticulous development by the People's Bank of China, the most sophisticated central bank digital currency project undertaken by any major economy in the world. Unlike Bitcoin or Ethereum, which are decentralized and operate outside government control, the digital Yuan was entirely state-controlled. Every transaction could be tracked. Every flow of money could be monitored. It was programmable, meaning it could be set to expire if not spent within a certain period, or restricted to certain categories of purchases. It was, in other words, the most powerful monetary surveillance and control tool ever created by any government in human history. But it also had genuine advantages for cross-border trade. It eliminated the need for correspondent banking through the SWIFT network, the system that America had weaponized against Russia. It settled instantly. It cut out the middleman. And for a country like Saudi Arabia, doing trillions of dollars worth of oil trade with China, settling in digital yuan meant settling outside the American financial system entirely. No SWIFT, no Federal Reserve, no U.S. Treasury, no exposure to American sanctions or asset freezes. The conversations started seriously in 2022. Saudi Arabia and China had been discussing yuan-denominated oil contracts for years. The Wall Street Journal had reported on these discussions as early as March 2022, but the talks had always stalled. The Saudis were cautious, the petrodollar arrangement was lucrative, and the political relationship with Washington, however strained, was not something they wanted to destroy overnight. But then something changed. In late 2022 and into 2023, the Mbridge project, a cross-border central bank digital currency platform developed jointly by the Bank for International Settlements Innovation Hub, the People's Bank of China, the Hong Kong Monetary Authority, the Bank of Thailand, and the Central Bank of the UAE, began achieving something remarkable. It began actually working. Real transactions, real value. Real cross-border settlement between real central banks, bypassing SWIFT entirely, settling in digital currencies in a matter of seconds, rather than the days it typically takes for international wire transfers to clear. The UAE's participation was significant. The Emirates had massive oil revenues, deep ties with China, and a strategic interest in financial diversification. They were, in many ways, a testing ground. And the tests were going well. Saudi Arabia was watching all of this very carefully. And in early 2023, Saudi Arabia officially expressed interest in joining the Mbridge platform. The announcement was relatively low-key. It came from the Saudi Central Bank, known as SAMA. But in the world of international finance, it landed like a thunderclap. Because Saudi Arabia joining Mbridge was not just about experimenting with new payment technology, it was a signal, a deliberate, calculated, unmistakable signal that the kingdom was seriously considering pricing some of its oil outside the dollar system. And then came the trade. The details of the first major Saudi oil transaction settled in digital yuan are not fully public, and this is by design. Neither Riyadh nor Beijing has any interest in making a dramatic public announcement that would be seen as a direct provocation of Washington. But multiple credible sources, including reporting from Bloomberg, the Financial Times, and analysis from the Atlantic Council's Geoeconomic Center, have confirmed that by 2023, yuan-denominated oil transactions between Saudi Arabia and China were no longer theoretical. They were happening. The mechanics of the transaction are worth understanding in detail because they reveal just how sophisticated this new financial architecture really is. Instead of the traditional model, where Saudi Aramco invoices the Chinese buyer in US dollars, the Chinese company buys dollars from the People's Bank of China, the dollars flow through the SWIFT network to Saudi accounts, and the Saudis then invest those dollars in US treasuries. The new model works completely differently. Saudi Aramco invoices in yuan. The Chinese buyer pays in digital yuan through the Mbridge platform or a related bilateral settlement system. The transaction settles in seconds. Saudi Arabia receives yuan in a digital wallet held by SAMA, the Saudi central bank. And here's the critical part. Saudi Arabia then has options that did not exist before. They can use those yuan to buy Chinese goods and services, which China very much wants them to do. They can hold yuan-denominated assets in the rapidly expanding Chinese capital markets. Or, and this is perhaps the most elegant part of the entire system, they can convert those yuan into gold on the Shanghai Gold Exchange, which is itself priced in yuan and represents one of the largest gold trading venues in the world. That last option is particularly significant. Gold has no nationality. It cannot be frozen. It cannot be sanctioned. It cannot be devalued by a foreign central bank. And China has spent the last decade quietly accumulating gold at a pace that most Western analysts believe is significantly understated in official figures. By routing oil payments through Xi'an and then into gold, Saudi Arabia and China are essentially creating a commodity-backed monetary system that operates entirely outside the dollar's reach. This is not a small thing. This is potentially the biggest shift in the global monetary order since Nixon closed the gold window in 1971. Now let's be clear about something important, because accuracy matters here, and this story is complex enough without exaggeration. The petrodollar is not dead. Not yet. Not even close to dead in the sense that the overwhelming majority of global oil trade is still priced and settled in US dollars. As of 2024, roughly 80% of global trade, not just oil, is still invoiced in dollars. The dollar still accounts for nearly 59% of global foreign exchange reserves, down from about 71% 2 decades ago, but still dominant by any measure. The financial infrastructure of dollar-denominated trade, the correspondent banking networks, the treasury markets, the swap lines between central banks, is so deeply embedded in the global economy that replacing it is not a matter of years. It is potentially a matter of decades. But here's what is different now. For 50 years, the petrodollar system operated on something close to a consensus. The major oil producers accepted it. The major oil consumers accepted it. There was no credible alternative, and the cost of defection, economic isolation, potential military confrontation was simply too high. That consensus has cracked. The precedent has been set. Saudi Arabia, not Venezuela, not Iran, not some sanctioned pariah state, but Saudi Arabia, the cornerstone of the entire system, the country that made the original deal with Kissinger in 1974, has demonstrated that it is willing and able to conduct major oil trade outside the dollar system. That is the story. That is the earthquake. Not the specific transaction, but what the transaction proves is possible. And the reverberations are being felt everywhere. In Moscow, Russian oil, now largely locked out of Western markets due to sanctions, is being sold to China and India in a complex web of currencies that increasingly excludes the dollar. Russia and China have almost entirely eliminated dollar usage in their bilateral trade, which, as of 2023, was running at record levels. The ruble-yuan exchange rate is now one of the most actively traded currency pairs on the Moscow exchange. In Tehran, Iran, which has been under comprehensive U.S. sanctions for decades and long ago stopped pricing its oil in dollars, has developed its own mechanisms for cross-border settlement with China, India, and other willing buyers. Iran and Russia have been quietly piloting arrangements for commodity-backed bilateral trade, projects that gained international attention when they were reported by multiple outlets in 2023. In New Delhi, India, the world's third largest oil consumer, has been increasingly open to buying Russian and Middle Eastern oil in rupees, or in arrangements that bypass the dollar entirely. India's oil purchases from Russia surged dramatically after the Ukraine invasion, and much of that trade has been settled in currencies other than the dollar. India's central bank, the Reserve Bank of India, has actively encouraged the development of a rupee trade settlement framework with dozens of countries as a direct response to the new reality of a multipolar currency world. In Beijing, the internationalization of the yuan is proceeding on multiple tracks simultaneously. The digital yuan for retail and cross-border wholesale payments, the Petro-Yuan futures contract on the Shanghai International Energy Exchange, launched in 2018, which allows oil contracts to be priced and settled in yuan. The expansion of China's CIPS system, the cross-border interbank payment system, which is a direct competitor to SWIFT and has been steadily adding member banks from around the world. And the network of bilateral currency swap agreements that China's central bank has signed with over 40 central banks globally, creating a web of yuan liquidity that makes yuan-denominated trade increasingly feasible for any country willing to use it. And in Washington, there is a dawning awareness that something fundamental has changed, even if the full implications are not yet visible in the headline data. The dollar's reserve currency status has been the foundation of American economic power for 3 generations. It allows the United States to run chronic trade deficits without consequence, because the world always needs dollars. It allows the U.S. government to borrow at lower interest rates than any other sovereign borrower, because Treasury bonds are the global safe haven asset of last resort. It allows the United States to project geopolitical power through financial sanctions in a way that no other country can replicate. Lose the petrodollar, and you do not just lose a trade arrangement, you lose the economic superpower status that has defined America's role in the world since the end of World War II. This is why the conversations in Washington about Saudi Arabia's flirtation with the digital yuan are so charged. There have been congressional hearings. There have been diplomatic dispatches. There have been, according to multiple reports, tense private conversations between U.S. and Saudi officials about the direction the kingdom is heading. The Biden administration dispatched senior officials to Riyadh repeatedly, attempting to shore up the relationship. The sale of advanced American weapon systems, long used as a tool to keep Gulf states within the American orbit, was part of those conversations. And Saudi Arabia, for its part, has been careful not to burn bridges entirely. Crown Prince Mohammed bin Salman has made clear that he values the security relationship with the United States, that Saudi Arabia is not pivoting entirely to China, and that the kingdom intends to navigate a deepening great power competition to its own advantage. The Saudis are not choosing sides, they are expanding their options. And in doing so, they are making a statement that is more disruptive than any outright break with Washington would be. They are saying, we do not need to choose. We can do business with everyone on our terms, in any currency we please. This is, in many ways, the real story underneath the transaction itself. Not a clean break, not a dramatic announcement, but a slow, deliberate, and likely irreversible process of financial diversification by which the world's most important oil producer is reducing its existential dependence on the dollar, one transaction at a time. And in the absence of any compelling reason to reverse course, that process will continue. The technology underneath all of this deserves a closer look, because it is genuinely revolutionary and frequently misunderstood by people who hear the words digital currency and immediately think of the volatile speculation that defines the retail cryptocurrency markets. The digital yuan is not a cryptocurrency in the sense most people understand that word. There is no mining. There is no blockchain in the decentralized sense. There are no anonymous wallets. The digital yuan is a direct liability of the People's Bank of China, just like physical cash, but in digital form. It exists in a two-tier system. The central bank issues digital yuan to commercial banks, and commercial banks distribute it to consumers and businesses. Every unit is tracked. Every transaction is recorded. This gives Beijing an unprecedented level of visibility into economic activity and, critics rightly note, an unprecedented potential for financial surveillance and control. But for cross-border oil settlement, these characteristics are features rather than bugs from the perspective of the parties involved. Saudi Arabia knows exactly where every digital yuan is going. China knows exactly what Saudi Arabia is doing with the yuan it receives. The transparency is mutual, the settlement is instantaneous, and the entire transaction happens completely outside the reach of any third party, including the United States government and the American financial system. The Mbridge platform, which forms the infrastructure underpinning the most significant of these cross-border transactions, deserves particular attention because its institutional backing gives it a legitimacy that purely bilateral Chinese-Saudi infrastructure would lack. It was developed with the explicit involvement of the Bank for International Settlements, the so-called central bank of central banks, based in Basel, Switzerland, through its innovation hub in Hong Kong. When the BIS is involved, it becomes difficult to dismiss a project as simply a Chinese monetary power grab. The participation of Thailand, the UAE, and the expressed interest of Saudi Arabia and other countries signals that Mbridge is evolving into something considerably larger than a bilateral experiment, potentially the embryonic infrastructure of a parallel global financial system that operates alongside, and in competition with, the dollar SWIFT architecture that has dominated since the 1970s. Zoltan Pozsar, the former Federal Reserve official, who became one of the most widely read analysts on the restructuring of the global monetary system, argued compellingly that the world was moving toward what he called Bretton Woods III, a new monetary order in which commodities and commodity-backed currencies play a central organizing role. In Pozsar's framework, the first Bretton Woods era was the gold-backed dollar system from 1944 to 1971. The second was the purely fiat dollar petrodollar system from 1974 to the present. The third will be a multipolar system in which the dollar competes with commodity-anchored alternatives, most significantly a yuan that is increasingly backed not by explicit gold convertibility, but by China's massive and rapidly growing commodity trading relationships and its ability to offer those relationships in its own currency. The Saudi digital yuan oil transaction fits precisely into this framework. And the reason it matters so much is not the size of any individual transaction. It is the proof of concept it represents. Once Saudi Arabia demonstrates that it can receive digital yuan for oil, hold those yuan in a Sama wallet, convert them to gold on the Shanghai Exchange, and suffer no significant economic consequence for doing so, the question that every other oil producer in the world will ask becomes unavoidable. Why are we still doing it the old way? This is how monetary revolutions actually happen. Not with a single dramatic event, not with a press conference or a declaration, but with a quiet transaction that works, that settles, that clears, and that then gets repeated and repeated again until the new way becomes normal and the old way becomes the exception. What happens next is genuinely uncertain. The pace of change will be shaped by decisions that have not yet been made by Saudi Arabia, by China, by the United States, and by dozens of other countries navigating the widening fault lines of a fracturing global order. A major escalation between the United States and China over Taiwan could accelerate the decoupling of the two financial systems dramatically and suddenly. A diplomatic breakthrough could slow it. A severe global recession could send investors fleeing back to dollar assets as the only truly liquid safe haven, reinforcing dollar dominance for another generation. The future is not written, but certain things now seem increasingly clear. The unipolar dollar world that existed from roughly 1974 to 2022 is over. Not because any single event destroyed it, but because a cascade of decisions, Russia's invasion of Ukraine, America's decision to weaponize financial sanctions at an unprecedented scale, China's decade-long investment in alternative financial infrastructure, and Saudi Arabia's quiet but unmistakable diversification away from dollar dependency, have together created a fundamentally different world. A world in which the dollar is still powerful, still dominant, but no longer unquestioned. A world in which alternatives exist, function, and are being actively used by major economic powers in real transactions involving real commodities. For ordinary people watching this from a distance, the question is obvious and entirely reasonable. What does this mean for me? The answer depends substantially on who you are and where you live. If you live in the United States, the declining influence of the petrodollar is ultimately a story about the future cost of American borrowing. As long as the dollar is the world's reserve currency, there's enormous global demand for U.S. Treasury bonds, which keeps American interest rates artificially low relative to what they would otherwise be. If that demand erodes gradually, If central banks around the world shift their reserves away from dollars and toward yuan, gold, or other assets, then the US government will need to offer higher interest rates to attract buyers for its ever-growing mountain of debt. Higher interest rates cascade through the entire economy. Higher mortgage costs, higher car loan rates, higher business borrowing costs, slower growth. The pain would be gradual, distributed across years or even decades, but it would be real, and it would be felt by every American family carrying a mortgage or a car payment or a credit card balance. If you live in China, this is a story about strategic patience finally paying dividends, about the long game that Beijing has been playing for 20 years. China's leadership concluded long ago that as long as China's economy depended fundamentally on dollar-denominated trade, China was strategically vulnerable in a way that its growing economic and military power could not fully offset. The digital Yuan project, the Mbridge platform, Shanghai oil futures contract, the Belt and Road infrastructure investments, the bilateral currency swap agreements, all of it is part of a single coherent strategy. To build the infrastructure of a yuan-based global trade architecture before the confrontation with America reaches a point where the dollar system is used as a weapon against China the way it was used against Russia. The Saudi deal is proof that this strategy is working. If you live in the developing world, in Africa, Southeast Asia, Latin America, Central Asia, this is potentially a story about liberation, not in a romantic sense, but in a very practical financial sense. For decades, developing countries have had essentially one option for international trade settlement: dollars, which meant they needed to earn dollars, hold dollars, borrow dollars, and remain perpetually exposed to decisions made by the U.S. Federal Reserve about American monetary policy, decisions that had enormous consequences for their economies, even though they had no seat at the table. The emergence of a credible yuan-based alternative, backed by China's massive trade volumes and its willingness to extend credit through the Belt and Road framework, gives developing countries genuine negotiating leverage they have not had since the end of the Bretton Woods era. That is not nothing. That is significant. The petrodollar was built on a handshake in Riyadh in 1974. It was constructed in secret, announced quietly, and sustained for 50 years by a combination of raw military power, the extraordinary depth and liquidity of American financial markets, and the complete absence of any credible alternative infrastructure. Two of those three pillars have now weakened substantially. Military power alone is insufficient to maintain a financial system that major economies are actively, successfully, and legally routing around using technology that America itself helped develop. And the absence of alternatives is a condition that no longer exists. The first major Saudi oil trade settled in digital yuan was not merely a transaction. It was a message, delivered in the language that moves the world more certainly than any army or any speech: the language of money. The message was clear to everyone who speaks that language. We have options now. We are using them. The arrangement that you thought was permanent is not permanent. The system that you believed was inevitable was always a choice, and we are choosing differently now. History is rarely dramatic in the moment it unfolds. The most consequential shifts in human affairs often look, from inside them, like nothing more than routine business. A barrel of oil changing hands, a digital wallet receiving a payment, a settlement system processing a transaction. But sometimes those routine moments contain within them the seeds of enormous change. Sometimes the ordinary transaction is the hinge on which history turns. The petrodollar took years to build and may take years, perhaps decades, to fully unwind. The process will be messy, contested, and full of reversals and detours. Washington will fight to defend its monetary privilege, as every declining empire has fought to preserve the foundations of its power. China will push forward, carefully, strategically, never faster than its own financial system can safely absorb. And Saudi Arabia will continue to do what it has always done best: play both sides of every great power rivalry to extract the maximum advantage for the kingdom, the royal family, and the Saudi people. But the direction of travel is now unmistakable. The petrodollar's era of absolute dominance is ending. The digital yuan is real, functional, and being used to settle oil trades between the world's largest oil exporter and the world's largest oil importer. The infrastructure that makes dollar dependency optional is being built, tested, and expanded every single day. And the geopolitical conditions that once made defection from the dollar system unthinkably costly have changed in ways that cannot be reversed by any single decision or any single administration. The clock is ticking, the transition is underway, and the world that emerges on the other side will be genuinely different from the world we have known for the past 50 years. Not necessarily worse, not necessarily better, but different in ways that will touch every economy, every currency, every government's ability to borrow and spend, and every ordinary person's cost of living, from Houston to Riyadh to Shanghai to Lagos. Understanding what is happening, why it is happening, and what it genuinely means, without exaggeration and without denial, is not a luxury reserved for economists and central bankers and hedge fund managers. It is something every informed person in this connected world owes to themselves. Because the financial order that is being renegotiated right now, in trading rooms and central bank offices and diplomatic meetings and digital payment platforms, is the foundation on which everything else rests. The day the petrodollar started dying was not announced. There was no ceremony, no press release, just a transaction, just a number moving from one digital wallet to another. Just Saudi oil paying for itself in the currency of China, bypassing the system that has governed global finance for half a century. And in that quiet moment, the world changed. The question is whether you noticed. Let us take a step back and appreciate the sheer scale of what the petrodollar system meant to the United States economy at its peak. During the 1980s and 1990s, the demand for dollars generated by the petrodollar arrangement was so enormous that it effectively allowed America to finance its Cold War military buildup, its massive expansion of social programs, and its dominant position in global technology and manufacturing, all simultaneously, without triggering the kind of currency collapse that any other country running similar deficits would have experienced. When the Soviet Union collapsed in 1991, many economists attributed it partly to the USSR's inability to compete with an America that was, in effect, being subsidized by the entire world through petrodollar recycling. The dollar's reserve status was not just an economic advantage. It was a geopolitical weapon of the first order. Saudi Arabia understood this. The Saudi Sovereign Wealth Fund, the Public Investment Fund, which now manages assets worth over $700 billion and is one of the largest sovereign investment vehicles in the world, was built on petrodollar recycling. The entire development of modern Saudi Arabia, its cities, its infrastructure, its universities, its healthcare system, was financed by the revenue from oil sold in dollars and reinvested through the American and Western financial system. For decades, this arrangement was genuinely mutually beneficial. Saudi Arabia got security, access to American markets, and a reliable financial system. America got cheap financing for its deficits and a stable oil supply. But here is what changed fundamentally in the decade between 2010 and 2020. America became, for the first time in generations, a net energy exporter. The shale revolution transformed the United States from the world's most desperate oil importer into a major oil exporter. Suddenly, the strategic rationale for the 1974 Kissinger deal was inverted. The United States no longer needed Middle Eastern oil the way it once did. And if America did not need the oil, the military protection it offered Saudi Arabia began to feel less like a partnership and more like a legacy obligation. Saudi Arabia read this clearly. The kingdom saw that its strategic value to Washington was diminishing, while its strategic value to Beijing, which was importing more oil every single year with no domestic alternative in sight, was growing by the day. The decision to explore digital Yuan oil settlement was therefore not a sudden act of rebellion. It was the logical conclusion of a decade-long reassessment of where Saudi Arabia's long-term interests truly lay, and that reassessment continues today. What we are watching is not simply a currency story. It is not simply a technology story. It is a story about power, about which countries will have the ability to set the rules of global commerce in the second half of the 21st century, about whether the post-World War II American-led order is genuinely transforming into something new, or simply absorbing a challenge the way it has absorbed challenges before. The digital Yuan, the Mbridge platform, the Saudi oil transaction are all chapters in that much larger story. And the chapter being written right now is one that will be studied by historians long after all of us are gone. Consider also what this shift means for the architecture of global sanctions, which has become the primary tool of American foreign policy in the absence of political will for military intervention. Sanctions work because the dollar is central. If you control the dollar, and through it the SWIFT network and the correspondent banking system, you control the financial oxygen supply of any country that depends on international trade. Freezing Russia's reserves proved that even a country with the world's largest nuclear arsenal and vast natural resources could be materially damaged by dollar-based financial warfare. But it also proved something else. It proved that the sanction weapon has limits. Russia has survived. Its economy contracted, but did not collapse, because China, India, Turkey, and dozens of other countries kept buying Russian commodities, often in non-dollar arrangements. The sanctions worked partially, not completely. And that partial effectiveness has given every country in the world's south a data point they will never forget. You can survive outside the dollar system. It is uncomfortable. It is costly, but it is survivable. And for Saudi Arabia, which has no intention of ever being sanctioned, but which wants the leverage that comes from knowing it could survive if it were, that data point is enormously valuable. The digital Yuan transaction is, among other things, an insurance policy, a demonstration that alternatives exist and work, a hedge against a future in which the relationship with Washington deteriorates further than anyone currently anticipates. This is sophisticated strategic thinking, And it deserves to be understood on those terms, rather than reduced to a simple narrative of Saudi Arabia abandoning America or China winning a currency war. The reality is considerably more nuanced, considerably more interesting, and considerably more consequential than any simple story can capture. The petrodollar died quietly, being replaced one quiet transaction at a time, right now, happening today.